Written by Dr.Yasam Ayavefe.
Market financing. Market financing is expressed by the asymmetry of monetary policy. As the prevailing visions become more optimistic, the prices of financial assets rise. This rise is controlled by inflation in the prices of goods and services, especially the intensity of loans. Fueled by cheap remaining credit. This is the competition created by commercial and financial globalization. But when asset prices plummet, especially when they crash, monetary authorities also open their credit covers to avoid bank failures and systemic risk. It should be emphasized that if their goal is to maximize growth, they should do so. The end result is an abundance of money that nurtures and certainly strengthens, if not provokes, the rise in asset prices created by more optimistic dominant visions. Thus, it is the imbalance in the mechanisms of monetary creation justified by the desire to maximize growth. In the future, other economic actors will be able or willing to leave them. At this point, knowledge, which is often so innocuous, suddenly changes the patterns of interpretation and the expectations of some, then of the majority, by imitation. We anticipate the collapse, and this expectation is self-fulfilling. However, the importance of liquidity, which was further increased by very generous monetary policy in the crisis, indicates that the downward movement has come to an end. That means the question then arises of what the next candidate asset type for rising prices is and how beautiful it is. We will build our vision of the world, built on a new interpretation model, to convince ourselves that this asset class has tremendous growth potential. Such crises are inevitable in market finance. They are the editing method. They periodically clean the system when it seems to have gotten a little too big. It is also very difficult to predict them. Modern finance regulations. Is this form of self-regulation of market financing controlled by monetary policy to avoid system risk? To understand this, it is necessary to answer two questions. 1. Is it satisfactory? 2. Can it be improved? The first question is normative. Without being discussed here, economic growth will be adopted as the norm. There is no doubt that the functioning of the global financial market system in the last 2 decades has led to crises in a number of developing countries. In some cases, an economic crisis similar to that triggered by the financial crisis, such as in Southeast Asia in 1997, may have practically no root cause. Financial imbalances could have been absorbed locally without causing such damage to another financial system. In other cases, as in Latin America, it is certain that major macroeconomic adjustments must be made. However, in order to implement these adjustments, the depth of the crises experienced by these countries must be looked at. Therefore, since the main problem is instability, it is necessary to look for ways to improve the stability of this system. But it must be admitted that the ideas are not many and the achievements are even less. Expansion of control rules is very slow, and enthusiastic financial innovations must be pursued continuously. With the discussion about the need for an international lender as a last resort, a system was established in which the major central banks acted in spontaneous harmony if necessary. The only truly original idea is that the IMF almost always acts as a public lender, allowing states to repay private creditors. However, due to the veto right of some states that did not want to talk about a supranational power, no progress could be made in this regard. But a state bankruptcy judge will have the power. More fundamentally, a reform in the current financial system can be done by 1. First things to do. Examining the data obtained since the 1929 crisis. Developing reviews. Effective use of state stabilizers. 2. It is necessary to change the nature of the system. We cannot really go beyond the nature of the system that no one has proposed or even envisioned. Global market finance is inherently volatile and the way it is regulated is decadent. There are many people who think that these collapses and their repercussions have nothing to do with innovations. Therefore, it is unlikely that finance is still very popular in their eyes.
Written by Dr.Yasam Ayavefe.